Hi, everyone, and welcome to the Buffett and Beyond ETF report for May 4th, 2024. And folks, the home builders ETFs are really rocking, and the hedges we use pay the bills. And let's look at the technology. And folks, we just had a 2-day rally, and I'm recording this on Friday, so the market's not closed yet. But what I want to show you is we had this big rise all the way. This is December. This is January right in here. So we had that decline, remember, going into January. Rallied all the way up, kind of stalled out, had our decline. And now we did a double decline in here. We're really worried a little bit, but then all of a sudden on Thursday, the market took off, and on Friday gapped up because we got a good jobs report, a weak jobs report, which means that it took pressure off interest rates, which means that the Fed doesn't worry or have to worry about even thinking about raising interest rates in order to fight its good fight against inflation. So here we are, this blue line up here. Well, first of all, up here, yeah, there it is. We like this bullish sign right here because as the market came down to test the previous low in here, this made a higher low, this indicator up here, and boy, it took off again. So that's what we want to see. Again, this is the 50-day moving average, and that is going to be attacked coming next week early. And down here, it looks like the decline is over. Finally, this black line crossing over the red line down here is giving us a buy signal as long as the market closes up today. And again, I'm recording this on Friday afternoon. Let's look at the semiconductor, and we see the exact same pattern. We see this higher high in here. We see this market going up, and it's sitting above its 50-day moving average. Came down to test it today, and boy, is staying up there. Nice move up here. Nice indicator telling us that we have a buy signal. And let's look at the transportation because the market follows the transportation. If the transportation's going down, that means it's transporting less goods, which means the producers or the wholesalers are producing fewer goods. Why? Because there is a less of a demand for goods, and that's how that all works, folks. So we have to watch the transportation average, and it was really scaring everybody until it came down, almost tested this 200-day moving average, and then all of a sudden jumped up. And what we see down here, these vertical lines, well, the gray lines represent the volume on the days the market closes up or this particular transportation index closes up. Red lines are when it closes down. So you can see how many red lines we had in there. But then on Thursday, all of a sudden, this market took off. And this is Friday in here, which we're not finished with the day yet. And down here, yep, it looks like this black line wants to cross over the red line. That will give us a buy signal on the transportation. So good move, good looking chart in here, folks. And let us look at the home builders because this is what I really wanted to talk to you about, because we have taken 2 stocks from our home builders and we put them in our growth portfolio. We're going to show you these in a minute, folks. This is exciting because the home builders, and we're using the XHB, say that 3 times, home builders, that's the spider, the S&P home builders ETF, and it's above this 50-day moving average, and that's what we wanted to see. So it gapped up above it, and it's holding there, folks. And yes, we have that buy signal down here, so we kind of like that. Now let's go to the home builders, and we want to look at the returns of the home builders. Well, the market itself, the S&P 500, is up 7%, and this is as of midday on Friday. So the market itself up 7%, but the home builders ETF is up 10.4%. Now, you know what we do here at Buffett and Beyond is we go to all the indices, we go to all the ETFs, and we say which are the above average stocks and which are the below average stocks. And then we take the above average stocks, we say which are the best stocks out of the above average stocks. And here we're looking at a return on equity that's above 20%. So these are the stocks over here, and we have looked at installed building products a couple of weeks ago. We said, wow, this stock is really moving, and now all of a sudden Carrier Global is looking very good, and installed building products up 35.5% this year. Down here, Williams-Sonoma up 51.7% this year. So what are the top stocks that we have that are above the 20% level that we look at in our charts? And yes, we have 1,800 stocks in our computer program, folks. Yeah, you really want to see that computer program. So we picked the top 8 stocks, and folks, up 19.4%. So if you pick the better stocks in any ETF or any index, you are bound to outperform just about all the time. And folks, when we do this, we always seem to outperform. And I have to say, put that disclaimer in there, that it won't always come true, but we haven't found many that have reverted to our top stocks underperforming the ETF itself or the index itself. So with the market up 7%, S&P up 7%, our top stocks are up 19.4%. They're the home builders, folks, and they follow the market or the home building index. But we picked the best out of that index, and that's why we're up 19.4%. We're up almost double the home builders ETF itself, because a lot of you like to go out and say, let me push one button, buy the home builders, see you later. But we say, well, let's take a couple of more minutes and pick the top stocks out of the ETF, and let's double the ETF and even almost triple the S&P itself. And remember, over any 10-year period, 96% of professional money managers who manage the publicly traded mutual funds cannot outperform the S&P 500. 96% cannot outperform this 7% right here. So, folks, we're doing pretty good with our method, which has a 22-year history, by the way. That's one of the longest histories you'll find out there. And I believe it's the best return relative to the risk that we take, because we don't like to take more than market risk. Now, let us look at Microsoft from last week, because we bought Microsoft we added to it. We've always had Microsoft, but we added to it in our ETF portfolio, or one of our ETF portfolios last week right in here, and then it came roaring down, and we got really upset. We were just sad for a good part of the week, and then all of a sudden the next day it went all the way up, and then 2 days later it came all the way down, made a double bottom in here, and now look at it taking off. So we have this indicator up here pointing up. We have this indicator down here finally looking like it's turning up and going with the black line going to cross the red line. We'll see in a couple of more days, but it looks like somewhere in here we added to our Microsoft positions and added it to one of our ETF portfolios, and yeah, there we are, looking nice again. And let us look at the top NASDAQ stocks, and I want to show you something. And let's get in here and look a little bit closer here, because what I want to show you is that we hedge, we use a 3 times inverse ETF, which is the SQQQ, and these are the top stocks in our QQQ ETF portfolio. So we've taken the top 12 stocks in the ETF also, and well, let's look at the QQQs, up 5.8% for the year, which is not too good, especially with the S&P up 7%. Very few times do you see the QQQs not outperforming the S&P 500. But what about the top dozen or so stocks that we picked? Up 28%, 4 times more than the S&P itself. And almost 6 times more than the QQQs itself. So our top stocks are up 28%. Now, what if we were hedged 30% and we could use the triple inverse ETF, which was made specifically for IRAs, because you can't go short in an IRA. So how do you protect these stocks without using a lot of money to buy puts? Well, you can do it with an inverse ETF, which was designed specifically for IRAs and those qualified accounts where you can't go short. So we're 30% hedged, but it only takes 10% of our buying power in order to hedge 30%. 3-to-1 inverse. So if we did that, we'd be up 18.2%. So if we're hedged 30%, and why 30? Why do we pick 30%? Because all our tests are done where we can take this portfolio of stocks, and we're looking at techs, we're looking at semiconductors, and a few builders in there, as we mentioned before, a few builders, and we look at those stocks and we say we want to have less risk than the overall market, but we want to be able to outperform the overall market. So how do you do that? Well, you can use those inverse ETFs. So if you're fully hedged all the time, so you're 30% hedged all the time, that's what makes it work. You'd be up 18.2%, which is more than twice as much as the S&P 500 itself. Now, what if we timed the hedging of the portfolio? So when certain indicators are going up, we would say, let's get out of our hedges. And when the indicators go down, we would get back into our hedges. Well, that would be up 25.6%, and we'd still be 30% hedged during the down periods. Now, of course, that's a little tricky to do at the tops and the bottoms, as we showed you in some of our charts just now, that it's hard to pick those spots. So we do a pretty good job at it because we've been doing it for about, 40 years? Not with the inverse ETFs, they're fairly new, but with options and going short back in the old days. So in other words, if we just bought these stocks, we're up 28%, we're up 4 times more than the S&P 500 by picking the top stocks in the QQQs, which is the NASDAQ 100. And if we timed our hedges, we'd still be up 25.6%. And if we were just hedged 30% all the time, we'd be up 18.2%, which is still much more than the S&P 500 and almost 3.5 times that of the QQQs themselves. So, folks, whichever way we do it, we're outperforming. Now, why do the timing? Because this extra money above the 18%, because you want to be 30% hedged, but do you have to be 30% hedged all the time? And we're saying the answer is no. So the difference between the 25.6 and 18.2, folks, right here, we're looking at 7%, more than 7%, 7.4%. So that could pay a money manager 1.5% to do this for you, or you could do it yourself. And if you are not good at timing, but you're following our newsletter, then you'll say, okay, I can give up a few points, but I'm there doing it myself. But this 25.6% will pay for you to have this portfolio managed, and you could go to the beach, and that's what it's all about, folks. And talking about the beach, if you want to be on the beach, like this specific beach where Jimmy Buffett used to walk at sunrise, and here we are at sunrise, then you've got to learn how to invest even better than Warren Buffett does now. So, folks, we had an unbelievable week this week, ending on such a good note. You go out, take it easy over the weekend, be with your loved ones, stay safe, and folks, we'll see you back here in a few days.